Good morning, it's 27th April. Here's your business news wrap. Quick heads up, this is an AI-generated summary based on multiple sources. Please verify key info independently. Also, none of this is financial advice or a buy-sell recommendation. Alright, let's dive into today's insights. First up, there's a big emphasis on long-term investing versus chasing short-term predictions. Many traders get caught up trying to time the market, but more often than not, that leads to losses. Instead, the focus should be on spotting future-oriented, high-growth companies. By analyzing sectors and assessing the strength of a business, you can get ahead of the curve. A critical skill here is sharp observation. Successful investors develop that keen eye to anticipate how society, technology, and the economy might evolve. Think about how shifts in education tools, children's tech, or Western innovations open up new business opportunities. Keeping an eye on these societal and tech trends can reveal potential multi-bagger stocks. It's also vital to track what's happening in developed countries. These markets often set the trends. Copying successful ideas from abroad and adapting them for Indian companies can be a real game changer. Plus, observing multiple sectors at once helps too. Seeing how a new product or innovation spurs demand across different industries creates more opportunities. Government policies play a big role in this landscape. Supportive policies can turn entire sectors into multi-baggers. Think renewable energy, ethanol, defense, and infrastructure. Conversely, restrictive measures can dampen growth. So, staying tuned into policy changes helps you identify promising investment areas early on. And speaking of disruption, early recognition of high-impact ideas is key. Electric vehicles, solar power, drone tech, AI applications, they're transforming markets. Patience and perseverance are essential because identifying potential multi-baggers isn't quick. It's about the calculated risk and trusting your own analysis over hype. Now, to highlight how consumer behavior influences growth, businesses driven by convenience, like food delivery and e-commerce, expand rapidly because they cater to our laziness. This creates big opportunities for investors willing to spot these trends early. An important personal skill is developing your own observation prowess. Trust your analysis, not just crowd sentiment or hype. Long-term investors excel by continuously scanning for innovative sectors, monitoring policy shifts, and anticipating societal changes. In the end, diligent, independent thinking combined with timely action in evolving sectors can turn your investments into multi-baggers. Now, shifting gears, let's touch on the ongoing Q4 updates, particularly shareholding patterns, things like promoter, FII, and DII transactions. Today, we are focusing specifically on promoter pledging. When promoters pledge shares, it's a signal to watch, but it doesn't automatically spell trouble. Still, pledging over 20 to 25% generally raises flags. That's like driving a vehicle at high speed. The more pledged, the higher the risk. For example, Jyoti CNC Automation saw promoter holding increase from about 1.79% to 4.11%, mainly because of share pledging. Similarly, Anupam Rasnayan India's pledging has steadily increased over 5 quarters, from roughly 9.3% to nearly 19%. Ola EIC jumped from 0 to over 10% pledged. Even established firms like TVS Holdings saw pledging go from 16% to over 14%, despite strong promoter ownership. In the mid-cap space, pledging climbed from around 40% to over 54%. Imami's pledging grew from 11.2% to over 13%, and PVR Inox's pledging rose from 5.86% to above 10%, even amid stiff competition. Kalyan Jewellers, with a stable promoter stake around 63%, saw pledging leap from 0 to nearly 25%. Raymond Lifestyle's pledging surged from about 3% to almost 26%. Monitoring pledging trends helps gauge potential financial stress or risks, especially when pledging exceeds 20 to 25%, which is where caution is advised. Keep an eye on these numbers, they are critical indicators of company health. Moving on, in the market today, activity remained sluggish, about an 80-point dip in the index, with little momentum. Major global and domestic economic data influenced sentiment. Notably, India's Q4 GDP grew at 7.4%, surprising many analysts who have been expecting lower numbers. This is a strong finish to the fiscal year, with the full-year growth averaging around 6.5%. This indicates that despite earlier slowdown signals, the economy performed better than expected. The demand and production in both goods and services suggest resilience. Globally, economies like the US and China show differing growth trajectories, the US at around 2.5%, China's data is debated, but India now ranks as the fourth largest economy. This encouraging GDP data is likely to attract further foreign investment as investors look favorably on India's growth prospects. The market reacted positively, with the GIFT Nifty jumping in anticipation of a promising Monday start. Still, some caution remains because of fluctuations earlier in the year and the need to see if this growth can be sustained. In summary, the key takeaway is that sustained, consistent growth alongside smart policy support and technological adaptation creates a fertile ground for investors. Keep observing societal shifts, industry trends, and policy changes. These elements, combined with patience and independent analysis, can help you identify those high-potential stocks that may become your next multibaggers. That's it for today's update. Don't forget, we'll be discussing more stock market strategies and analysis in upcoming classes. Subscribe so you don't miss out. Thanks for listening. See you next time.